The market's attention this week was focusing on the second round of the LTRO programme. In effect, this programme is what we call QE, for want of a better word, where in effect the ECB, the central bank, provides very cheap facilities to the banks in return for some of their assets, and we know that they will accept a very wide range of assets and possibly not the highest of quality. Where they draw the line, we are told, is that they won't accept Greek bonds, but as I say, I think everything else appears to be up for grabs. 800 banks took part in this LTRO programme, and they took in effect about 523 billion euros from the ECB. This follows the near 500 billion from last time. So in effect, the ECB now has funded about €1 trillion euros of funds to the banking sector, and we believe that that largely accounts for the financing requirements of the banks over the course of the next 2 years. So overall, the market reaction to this is that they have built a sufficient firewall around the problem and given the banks certainly enough breathing space for the next sort of stage of events. So so there's a sense of relief there. So let's see how that sort of played out in the financial markets. The first area I'm going to pick up on is oil. And maybe an unusual chart in the context of what we've just been talking about, but what people are naturally saying is there's a hell of a lot of money coming through the system now, how will this sort of manifest itself into hard assets? And commodities to some extent have been the major play over the course of this period, and oil very much is a feature. Oil is a play to some extent on a recovering global economy and demand for oil, and as we can see here, this is the WTI oil, which has over the course of February now sort of moved up from 96 to about 108. Now naturally this is in a sense a positive sign. It shows that things are recovering around the world, but what one doesn't want to see is the oil price run too hard, because naturally it's the price or cost for many businesses and starts to slow economic growth if oil goes too high. The analysis I've read this week suggests that this recent rise is not sufficient at the moment to cause a problem, but it has to be monitored and monitored fairly carefully. Now let's take a look at some of the other features of the week. I've just been interested to see how sterling is reacting. We've obviously had relatively benign economic conditions in the UK at the moment. I don't think it's by any means following the US recovery in the way that we've seen the GDP numbers coming out from there. And indeed, we've seen the Bank of England put another 50 billion into the economy through its own QE programme. But nevertheless, sterling is holding well in this environment. There were a couple of wobbles in the course of January, as we can see here. We commented upon that sort of trend. But that trend never really persisted, and in a sense now we're just breaching around that sort of 159, 160 level there at the moment. So steady on sterling. This is the FTSE 100 index, and if we just really highlight the way that the market has responded to the initial LTRO programme, which was in mid-December at this point here, we've seen this recover. The FTSE, in fairness, has not been the best performing market since that time. We've got better performances out of Germany and other European markets, what the technical analysis would show at the moment is that we're finding quite a bit of resistance around this 5,920 level at the moment, struggling to break through. It's getting close to 6,000. Once or twice I've thought that we may see a 6,000 print. It can't be far away, but at the moment just struggling to break through that sort of top end of the range. But nevertheless, the key thing for me is that when we do see negative news, we don't necessarily see this market sell off, and so it's a market that feels well underpinned at this stage. Now this is a chart that for Apple shareholders will show a very pleasing pattern here. We've seen the chart move up, really breaking through $400, and look how quickly that has moved to over $500, trading at $544. It means this company is now the most highly rated or highly valued company in the world at over $500 billion, and they're talking this week at the impending launch of the iPad 3, which is continuing to keep that particular train on the march. We have a research note on that stock for anyone that's interested. And finally, I just want to say that despite all of the efforts of the ECB to get to grips with the European problem. The one issue that we again is keeping an eye after Greece is Portugal. It's interesting to note that following the announcement of the LTRO programme, that yields in Portugal did begin to rise again and rise quite sharply off this 12% level back up to 13.8%. Not much more to comment upon this at the moment, but it's one to keep an eye on, as the thinking here is that Portugal will need considerable assistance through this particular stage of the cycle, and with those yields I think will become a little bit more a barometer of that news and how quickly that is due over the course of the next few weeks.